Have you ever stayed up at night stressing over a stock market dip or wondering how to keep your money safe in shaky times? The Great Depression of 1929 was the ultimate financial stress test, and millions lost everything because of mistakes we're still making today. Ignoring those lessons leaves any investor exposed when markets get rough. But here's the good news. In this video, you'll learn practical, time-tested strategies straight from the Great Depression to invest with confidence, even when the market tanks. No jargon, just clear steps you can use right now. We'll cover everything from dodging traps like reckless speculation to building a crisis-proof portfolio. Ready to take control of your financial future? Let's dive in. Picture this. October 1929, Wall Street's a mess. The stock market crashes, banks collapse, and millions lose their jobs. The Great Depression wasn't just an economic downturn, it was a financial earthquake that crushed dreams. So, what went wrong? And more importantly, how does it connect to your wallet today? It all started with financial mistakes that sound like a playbook of what not to do. First, wild speculation. People bought stocks with borrowed money, betting the market would only go up. Spoiler, it didn't. Second, no diversification. Many put all their cash into one sector like railroads, and when it tanked, they lost everything. Third, panic. Mass bank runs made things worse because nobody trusted their money was safe. Sounds like ancient history, right? But think about it. Ever jumped into a hot investment like a cryptocurrency everyone's hyping? Or sold stocks in a frenzy when markets dropped? Those mistakes are still out there, dressed up as meme stocks or headline-driven panic. So what can the Great Depression teach us to avoid these traps? Let's break it down with the first lesson. Lesson 1. Steer clear of speculation and invest smart. Back in the 1920s, people were buzzing about the stock market. It felt like everyone could get rich quick. Many borrowed money to buy stocks, a trick called leverage. Here's how it works. You put in $100, but borrow $900 to buy $1,000 worth of stocks. If they rise 10%, you make $100 minus interest. But if they fall 10%, you lose it all and owe money. In 1929, the market crashed over 80%, and leveraged investors got wiped out. The lesson? Never invest money you don't have. Instead of chasing the next big thing, focus on fundamentals. Companies with steady profits and a solid track record. Think of the meme stock craze like GameStop in 2021. Tons of people bought at the peak, driven by hype, and lost big when it crashed. Want a practical strategy? Cap any single investment at 10% of your net worth. That way, if it flops, you're not ruined. And always do your homework. Check the company's website, financial reports, even news. It's not glamorous, but it's smart. On to the next lesson. Lesson 2. Diversification is your shield against crises. During the Great Depression, many investors dumped all their money into one sector, like railroads or banks. When those collapsed, they lost everything. It's like putting all your eggs in one basket and then dropping it. The lesson is simple. Spread your investments around. That means splitting your money across different asset classes, stocks, bonds, real estate, and sectors like tech, healthcare, or energy. One easy way to do this today is through ETFs, or exchange-traded funds. An ETF like the S&P 500 gives you a slice of 500 major companies. If one goes bust, the others balance it out. Back in the Depression, diversified investors took less of a hit. For example, if you'd split your money 50% in stocks, 30% in bonds, and 20% in gold in 1929, your losses would have been way smaller. Want to start? Open your brokerage account and search for an S&P 500 ETF. It's straightforward and slashes your risk. Let's move to Lesson 3. Lesson 3. Plan long-term and keep your cool. During the Great Depression, panic was everywhere. People sold stocks at the worst possible time when the market was at rock bottom, locking in huge losses. But guess who came out ahead? Those who held on and waited for the recovery. Markets always climb back up over time. For instance, if you'd invested $1,000 in the S&P 500 in 2008, right after the financial crisis, you'd have over $4,000 today. The lesson? Build a long-term financial plan and don't let emotions drive your decisions. 2 practical strategies can help. First, keep an emergency fund. 3 to 6 months of expenses in an easy-to-access account, like a high-yield savings account. That gives you peace of mind so you don't have to sell investments in a pinch. Second, use dollar-cost averaging. Invest a fixed amount every month, say $100, whether the market's up or down. It lowers the risk of buying at the wrong time. Ever sold something out of fear? Drop a comment. Let's hit the next lesson. Lesson 4. Rebuild trust in banks by choosing safe ones. During the Great Depression, faith in banks vanished. People rushed to withdraw their cash, which made banks fail even faster. In 1929, thousands of banks went under because they couldn't cover withdrawals. That led to regulations like the FDIC in the US, which ensures deposits up to $250,000 per account. The lesson? Pick banks that are secure and insured. Before opening an account, check if it's FDIC insured or the equivalent in your country. Most major banks like Chase or Wells Fargo are covered. Also look up the bank's credit rating on sites like Moody's or Fitch to ensure it's stable. A solid bank is the foundation of your financial plan. Want a tip? Visit the FDIC's website to confirm your bank's coverage. That peace of mind lets you focus on investing, not worrying. On to the next lesson. UNHCR, the UN Refugee Agency, has launched an appeal for USD 10.3 billion to support 4 million refugees, 6 million internally displaced people, 2.2 million asylum seekers, 5 million other people in need, and 2.7 million stateless people in 2025. This funding will provide life-saving protection and solutions in 135 countries. Learn more at unhcr.org. Lesson 5. Escape the trap of personal debt. In the Great Depression, countless families were drowning in debt. Mortgages, car loans, even consumer credit. When the crisis hit, they lost homes, cars, everything. Debt was like a chain around their ankles, making recovery nearly impossible. The lesson? Avoid unnecessary debt and aim for financial freedom. Here's a strategy. Prioritize paying off high-interest debt first, like credit cards, which can charge 20% or more annually. Try the 50-30-20 rule to manage your budget. 50% for essentials, 30% for wants, 20% for savings or debt repayment. In the Depression, those with little or no debt fared better. It's the same today. Less debt means more freedom to invest. Want to start? List your debts tonight, sort them by interest rate, and tackle the priciest one first. Let's move to the next lesson. Lesson 6. Shield your money from inflation. The Great Depression saw deflation, falling prices, which was rough. But today's inflation is just as sneaky, eating away at your purchasing power. Back then, people with real assets, like land or gold, held up better because those held their value. The lesson? Invest in assets that outpace inflation, like stocks, real estate, or inflation-linked bonds. For example, Treasury inflation-protected securities or TIPS. Adjust with inflation to keep your money's value intact. If inflation's 3% and TIPS pay 2%, you're earning 5% total. In the Depression, real assets were a lifeline. Today, they're your defense against rising prices. Want a tip? Check out TIPS or real estate investment trusts in your brokerage account. They're simple ways to stay ahead of inflation. Let's go to the next lesson. Lesson 7. Automate your investments for discipline. In the Great Depression, those who stopped investing during the crisis missed out on buying assets at bargain prices. Consistency is key. The lesson? Automate your investments to sidestep emotions and stay on track. How? Set up automatic contributions through your brokerage. For example, schedule $100 a month to an ETF or mutual fund. It's like putting your finances on autopilot. Here's proof. Someone investing $100 a month in the S&P 500 since 1929 through every crash would be a millionaire today, thanks to compound growth. Most platforms like Vanguard or Fidelity make auto investing a breeze. Want a tip? Tonight, log into your brokerage and set up a monthly contribution, even if it's just $50. Small steps add up. Let's wrap up with one final lesson. Lesson 8. Stories of recovery to spark inspiration. The Great Depression was brutal, but it also gave us incredible stories of grit. Imagine a housewife starting a bakery from scratch to feed her family, or a worker opening a repair shop with old tools. These folks turned crisis into opportunity. The lesson? Crises are tough but open doors for those who think creatively. Today, that might mean investing in recovering sectors like clean energy or launching a side hustle. In the Depression, creative action meant survival. Look at 2008. Those who bought into companies like Amazon when they were cheap reaped massive rewards. Want a tip? Research growing industries in your area, maybe renewable energy or healthcare, and explore ways to invest. Crises always breed opportunities, and you can seize them. Let's tie it all together. Tie. The Great Depression handed us 8 lessons to bulletproof your finances. Dodge speculation, diversify your portfolio, plan for the long haul, pick safe banks, avoid debt, beat inflation, automate investments, and see crises as opportunities. These time-tested strategies give you the confidence to invest, no matter how wild the market gets. You don't have to fear market drops or scary headlines. With a solid plan, your financial future is in your hands. Want to make it real? Drop a comment with which lesson you'll try first. Subscribe and hit the bell for more practical tips. One final tip: take 10 minutes today to calculate your emergency fund or set up an auto investment. Small moves change everything. Let's build a crisis-proof financial future together.